So the example would go as follows. On the 31st of December 2022, Protein Limited's commission amount or account shows an income of 2,000 Rand, and then a closer examination revealed that 200 Rand and in commission is not yet been received. So basically, it means that you have received all of those amounts for all of those months, but you are left with the final month, which is December 2022. Your adjustment journal will be debit the accrued income, and you're going to credit your commission income itself with an amount of 200 Rand. And then your closing journal transfer would be debit your commission income with an amount of 2,400 Rand. I think I made a mistake here. It's supposed to be 2,200 Rand. Let's look at the amounts. And closer examination revealed that 200 Rand and in commission has not yet been received. Okay, sorry about that. It was actually for the previous 2 months that was actually not received. Right, and the ledger account would be as follows. Your commission account itself, you're going to debit the profit and loss with an amount of 2,400 Rand, and you credit the balance brought down 2,200 Rand, and then you also credit your accrued income with an amount of 200 Rand. Okay, so I think I made a mistake here. It's supposed to be not 2,000, it's supposed to be 2,200 Rand. Just to match, yeah, like this. And then you are going to have the accrued income itself with an amount of, let me get this figure. It's supposed to be 200, sorry. 200 Rand, and the profit and loss account is going to be with an amount of 2,200 Rand. So under the statement of financial position there, you're going to have what's called the data under your, because we haven't received that money, that means it's raising the data. So under your statement of financial position in the current assets, you're going to have trade and other receivables, and then you put that amount of 200 Rand. Bad debts, which is your credit losses, it relates to the clients who cannot keep up with their debt agreement with their creditors, right? And the examples would go as follows. On the 30th of November 2022, like a month before close up books, Protein Limited received a notification that a debtor, Mr. P. Mukaba, is insolvent, and on a close examination, we revealed that the debtor owes an amount of 300 Rand. So this debtor must basically be written off. Okay, so the adjustment journal will be you debit your credit losses. That's an expense with an amount of 300 Rand, and you're going to credit the account data itself because the data is actually decreasing with that specific insolvent data with an amount of 300 Rand. And your closing transfer will be the profit and loss with an amount of 300, and you credit your credit losses. The amount again is 300 Rand. A ledger account would entail credit losses or bad debts, and then you're going to have trade debtors P. Mukaba. It's an asset with an amount of 300 Rand, and then you're going to credit your profit and loss as an expenditure with an amount of 300 Rand. Right, and then we have trade and other receivables with their balance brought down of 300 Rand, and then the credit losses will be with an amount of 300 Rand, so that will equal to 0. So you're going to include the credit losses and expense under your profit and loss. That's your income statement with an amount of 300 Rand. And then you're going to have the trade receivables ledger. Remember, the trade receivables ledger is actually for that specific data. So your balance brought down will be 300 Rand. And then you credit the credit losses with an amount of 300 Rand as well. Okay. So there we come into the bigger portion of the learning unit. That's your long-term adjustment. We spoke about it. It's depreciation. This relates to the business assets that are not for resale. It's not like any inventory. It's asset like your vehicle or the machinery that are used for the production of income. So, but for the business operations, and they decrease in the value over their useful life, depending on how long the company has measured that to actually produce an income for the business. And we call that the depreciation. So those that were in the text class, they know that depreciation is called the wear and tear. But we therefore need to open an account for the depreciation for this specific asset. And the contra allocation account is the accumulated depreciation. It's an asset. Right. So basically what happened is because we recognize depreciation as an expense, it's going to increase on the debit side. It's going to be shown on the debit side. And then your accumulated depreciation will be shown as a contra allocation account on the credit side. Depreciation will be written off against the profit or loss statement. And the accumulated depreciation will be subtracted from the cost of an asset to determine the carrying amount that has to be shown under the statement of financial position as a non-current asset. And also, it forms part of your property, plant, and equipment. That's your PPE. One examples would go as follows. Property Limited bought a machinery at a cost on the 1st of August 2022, amounting to 120,000 rand, and its accumulated depreciation amounted to 6,000 rand, and the depreciation must be calculated at 15% at the reducing balance method, or on the reducing balance method, rather. Let's see on how this thing has been worked. The cost, because we are now complying with this method, the reducing balance method. I hope this thing doesn't freeze. Because we are now complying with the reducing balance method, the method says that you need to take the cost and then you minus your accumulated depreciation and adjust it by the rate given. All right, and then you're going to look at for how long have you had that asset. So it says here that it's the cost and you minus the accumulated depreciation at 15%, and because of it was purchased 5 months prior the year end, we then have to apportion the month relevantly. This is how the workings have been done. You'd say 120,000 minus 6,000 is equal to 114, and then you minus this, or sorry, you multiply this by 15%, because we've got 5 months before the end of the period. You say 5 divided by 12. It gave me an amount of 7125. Let's have a look at how the adjustment has been treated. So you debit your depreciation, and then you credit your accumulated depreciation with the same amount. Remember, the contra allocation account is the accumulated depreciation for depreciation. Closing journal transfer, profit and loss, 7125. Remember, it's an income statement account. And you're going to have the depreciation of 7125. And the ledger accounts would be you debit your accumulated depreciation, 7125, and then you credit your profit and loss with 7125. And the accumulated depreciation, credit depreciation as a contra allocation account, 7125. And then you're going to have the profit and loss. And then the contra allocation of the account itself is the depreciation with an amount of 7125. So you draw up your statement of financial position, which is at 31st December 2022. And then you're going to have your asset, and then you have your non-current asset as a PPE. So when you look at this asset, this is how you do your note on property, plant, and equipment. Your cost is 120,000 rand, and then your accumulated depreciation is 6,000 rand. It's 6,000 rand, and then your carrying amount at the beginning of the year, it will be, or in that period, it will be 114,000 rand. And then you're further going to deduct your depreciation, and then your carrying amount. In your carrying amount, it will be 106,875. That will be the carrying amount that has to be disclosed under your statement of financial position at the end of the financial period. And that will bring us to the end of our learning unit 6. Before I go further, or before I give you a little bit of a break, any questions? Anzani?
I'm fine, sir.
You had a problem with the ledger accounts on this one. Are you fine this time around?
Yes, I'm fine.
All right. Jimmy, are you there? Mr. Motsi? Jimmy, are you there? Okay, Jimmy seems to be quiet. I think maybe he went out for...
No, I'm here.
Oh, you here?
Yes, I think I would... Is it possible for you to post the previous link or tutorial classes so that maybe one should go back and try and see how it has been treated?
Yeah, that's not a big deal. But you'll have to send me an email so I can send you notes specifically. I don't have a platform where I can send it for everybody.
Oh, okay.
Yeah, but I'll give you my details at the end of the session, and then I will send you all of those notes that you are looking for.
Okay.
And I think you'll be sorted. Okay.
Thank you. Thanks.
Okay, this is going to be our last learning unit, and we're just going to emphasize on the closing procedure and determining the profit of the entity and the preparations of the financial statements itself. Okay, that's going to be the end of our learning unit or topic B, and then like I said, on Tuesday we'll focus on topic C. But the introduction would go as follows: accounts which remains in the trial balance after closing, which consists of an asset, liabilities, capital accounts, must be in the statement of financial position. But we all know that the accounts that consist of the incomes and the expenses, they go to the statement of profit and loss and other comprehensive income. So to emphasize it more, the statement of profit and loss, it's actually your income statement, and the statement of financial position, it's your balance sheet. So that's the term that they used to use way back before. Things have changed. So when you look at the financial performance of a service entity, on how you determine the profit and loss for the entity as part of the performance. So each and everybody who's starting a business, basically, the main aim is to make a profit, and then you serve your client or you service your clients. And then at the end of the day, or the motive is actually to make profit. So that's where our income statement is. Okay. So let's have a look at the components of the financial statement of the service entity or just an entity as well. But gross profit, which is the difference between the sales and the cost of sales, and they can also be determined by opening a T account, which is called the trading account. So sometimes they would say determine the gross profit by following the T account, not by following that framework that we are used to. So what you do is to open up the T account, and then you do your vertical and horizontal line, and then you show me the sales on the credit side, and then you show the cost of sales on the credit side. If you're not given the cost of sales, remember the process of calculating that. Opening inventory, purchases, your carriage, and then you minus your closing inventory, it will give you your cost of sales. And then your cost of sales deducted from the sales, it will give you the gross profit. And then you are done. So the profit or loss for the period, that's the difference between the gross profit. Remember, sales minus cost of sales gives you the gross profit, and the expenditure incurred for that period, and the incomes and other expenditure accounts are closed off and transferred through to the profit and loss account. So basically what you do is the profit and loss account can be done in form of a T account as well. So what you do is you're going to have your gross profit, and then you're going to have your expenditure on the debit side, and then you minus the two to give you the profit or to give you the loss. So it's not always the time where you are actually doing the financial statement, particularly the income statement, and you derive it at a profit. Sometimes you might even run at a loss or break even. Okay, so the profit or loss, you can also do it in a form of a T account as well. Right, let's look at the cost price of sales. So prior to looking into the cost price of sales, we need to look at the inventory movement, because not all of the inventory purchased during the year will be sold, and therefore the inventory left and sold at the end of the year will be the opening inventory in the next financial period. Like I said, with regards to inventory, not inventory that all this business, for example, Pick n Pay, when they do their financial statements, obviously there are going to be some tin stuff or maize meal or meat on the shelf. And then they're going to do what's called physical counting of how much that does that stock on the shelf worth. So whatever that is attached to the stuff that is actually left on the shelf is going to be transferred as an opening inventory in the next financial period. But how you do that is going to be an opening in the statement of profit and loss, but you're going to disclose that under your statement of financial position as a closing inventory under your current assets. That's how you're going to split it. So when you do the statement of financial position, that inventory that is left, you'll put it there, closing inventory. And then when you do the next financial statements, under your income statement, you're going to have that as your opening inventory. So it will depend on the company as to whether they add or not. So if they add, they will have what's called an additional inventory, and they're going to add it to the opening inventory that we have in the next accounting period. Okay, our next part is going to be the inventory systems. We have what's called the perpetual inventory system, and then we've got what's called the periodic inventory system. The treatment is different in this way. The purchase of inventory under the purchase inventory system is recorded directly into the inventory account at cost, and as soon as the sales actually occurs. So the cost price of the goods sold is transferred directly from the inventory account to the cost of sales account. So each transaction, the effect of transactions regarding the inventory under the type of the system will occur differently depending on how the inventory was bought and sold. Okay, there's a point I'm looking for under this method. Right, important rules first under the perpetual inventory system. The cost of sales is determined with every sales transaction, and then you debit the cost of sales, and then you credit inventory because it's going out of the business. So no purchases of the purchases return account are kept. A physical account will only disclose the shortages or the surplus of inventory. So this is how it works. When you do the perpetual inventory system, you open what's called the inventory account. There is no purchases and there is no any purchases returns for any defected goods. Right, and how do you determine the goods? It is important to establish whether the markup was made on cost, price, or selling price. This is where the students are actually getting confused. So what they're trying to show you here is you can't buy goods from the supplier, let's say, for 20 rands, and then you sell them to the clients for 20 rands. There's going to be a lot of aspects that you are actually going to encounter, which are the delivery of the goods. It's an expense. The people that are putting the goods on the shelves, they need to be paid salaries. The rental on the floor, the electricity, and all of those. So what they do is, for them to actually make a profit, they have to bring what's called the markup on the cost of those goods. So in accounting, we use 25%. So the cost price of what you've purchased the goods on is 100%. Let's say it's 20 rand. And the markup will be 25. And then that means that you're going to sell it at 125%. Your profit will be 125. Sorry, it will be 25%. Okay, that's how it is in terms of the cost. If you get a question like this one, then it should be clear for you too. But you rarely get this kind of a question. So you should always multiply by the smaller. So you should always multiply by the smaller percentage figure and divide it by the bigger percentage figure. Right, let's have a look at where the markup is actually on 25% of the selling price, meaning that we are prepared to go lower. The question is, what factors would make the supplier, the retail stores or the company to go lower? Right, let's say, for example, let's take Woolworths. Expiry date can make the company to make sales at a lower markup. Actually, we call them the markdown. All right, so it can be the expiry dates. It can be that there's a change in fashion. It can be that there's a change in season as well. It can be that the company just actually want to make sales, but there should be a reason behind as to why they're doing the markdown. But we see that in most of the time on seasons, and the product are actually closer to the expiry date. Right, the second one will be the periodic inventory systems. So we are actually going to open a separate account called the purchases, and that should be the inventory. That should be the inventory to be returned for some reasons. Then the purchases returns account must be open. So this is what happened. I think this is what Jimmy is looking for. We did this before on topic A, where we dealt with the subsidiary journals. If not topic E, topic B at the beginning, where you're dealing with your cash receipts journal, cash payments journal, sales returns journal, purchases journal, purchases returns journal, along with your general journal. There are reasons why you are actually opening there. For example, in terms of the purchases, we know that when you're purchasing goods on credit, that doesn't go to the cash payments journal because it's a credit. Then you open up what's called the purchases account. And then if whoever your client that you sold the goods to, if the goods that we purchased on credit had a problem, let's say the defect, what's going to happen is we have to take back them to the supplier, and then we are going to create a journal called the Purchases Returns Journal. Right, and it further says that the cost of sales under the system is not determined at the time the recording of sales. However, it can only be determined at the year end after the physical inventory count has been done. So whether you are actually following the purchases, the perpetual inventory system or the periodic inventory system, at the end of the financial period, there must be a physical inventory count just to check as to how much of the inventory are we left with. Right, and then inventory will be determined directly depending on how was it purchased or sold. All right, let's have a look at the important rules under the periodic inventory systems. So the purchases and its returns are kept, and no cost of sales account. Remember, it's only kept in the perpetual inventory system. Physical inventory count, despite the method we are in compliance with, is vital or is essential. All right. Additional pays cost include the following: carriage. Remember, this is when you calculate the cost of sales or determining the inventory. The railage, customs and excise duty. Okay. So carriage, usually it's actually on how you carry that stock that has been purchased, and railage as well, it will apply to that. Customs and excise duty. I don't know if you guys have been at the airport. There's this police people that they wear the uniform called customs. So those are the police that are appointed by government, but they specifically work for SARS. So when someone buys goods abroad, they're going to check whether there's a compliance in regards to the customs and excise duty. It means that they have to be verified. So when you see those people at the airport, just know that they've got an office somewhere where they just have to do a little verification or detection if there's anything suspicious in regards to your purchase of goods. Okay, and I think this is going to be the last part, and then we'll move on to our questions. Drawings and donations of inventory. When the inventory taken by the owner under the perpetual inventory used for personal use, it says that we have to debit our drawings, and then we credit the inventory. And then when the donation of inventory under the perpetual use, donation of the inventory under the perpetual inventory systems, meaning that you're going to debit donation and then you credit inventory. So inventory would always be created. And the reason why is because it's always regarded as it's moving out of the business. So whoever that is taking that is actually encountering a loss because there's no payment towards that. That's more like an expense. And then there's a drawings there. We are affecting our equity. So inventory will always be on the credit side. It's there in the study guide. Make sure that you revisit that, or as per your request your notes, you'll be able to see as to whether you are following it or not. I can send you those notes and then you'll see them. So number 3 says inventories taken by the owner for personal use under the periodic inventory systems. So you're still going to have your drawings and then you credit purchases. Okay, and the donation made by the owner under the periodic inventory systems, you're going to have donations and then you're going to have the purchases. Right, let's close off our nominal accounts. Nominal accounts are closed by means of the closing journals and transferred to the trading account. And then the gross profit is determined in the debit or to the trading account and credited to the profit loss account. All other nominal accounts, including the credit balances such as the incomes, are debited and the profit and loss are credited. I'm going to come and explain that part. And then all other expenses account with a debit balance are credited and the profit and loss account is credited. The difference between the debit and the credit sales of the profit or loss account results in the profit and loss account, which is then transferred through to the capital account, and profit and loss is then closed off. All right, let's have a closer look at bulletin number 3, which says all other incomes account with the credit balance, such as incomes, are debited and the profit and loss are actually credited. The bigger question should be, why are we actually doing things? Right, closing transfers, the standard tells us that when you do the closing transfers, you're more kind of like doing things in the reverse. Remember, your initial stage in terms of the incomes they are opened on the credit side. But when you do the closing transfers, we are reversing things now and we bring the incomes on the debit side and the expense would be on the debit side. Here, the assets are actually not affected and the equities are actually not affected, right? But bear in mind that initially, the normal standard says that the income increases on the credit side and they decrease on the debit side. But when we do what's called the closing of the nominal account, the incomes are actually debited and the profit and loss, which represents the expenses, they are credited. So that's when you are actually doing the channels. Bulletin number 4 is actually giving you the reverse of bulletin number 3, which says that all other expenses with the debit balance are credited and the profit and loss account is actually credited. That's supposed to be an income. Okay. Did you all get that part? So you need to be careful. When they ask you the normal journals or the closing transfer journals, you must just know that you go the opposite way. Closing transfers or the settlement discounts. Discount granted transfer to sales. We transfer the discount to the sales account. We debit the sales account due to the decrease, and then we create the settlement discount decrease. So when you are actually granting a discount to the clients, basically you are reducing your profit in a way. If you're saying that I'm giving you 5% of the sales if you buy up to so much, meaning that on that sales, you're not going, let's say you're giving 10% on 100 Rand, which is 10 Rand. Instead of you having 100 Rand, you're going to have 90 Rand, right? That's your discount granted. Right, let's look at the discounts you received that are transferred to the purchases. It happens when you are actually purchasing goods. Getting to be granted the discount where we debit the discount and the purchases account is actually credited. All right, purchases, you know, normally is an expenditure. It increases on the debit side and decreases on the credit side. But because we're dealing with the closing transfers of this nominal account, that's why it's actually going through the opposite side. Profit and loss account include gross profit and add all other incomes, and then you deduct all of the expenditure. And then your final figure there, it will be the profit or it will be the loss. Okay. Then we have, let's see, because I was looking for my question. Right, we're having what's called the gross profit. It is normally expressed, this is actually a gross profit percentage, sorry. It is normally expressed as a percentage of either selling price or the cost price of the goods. So the formula will be gross profit divided by the selling price, and then you multiply by 100, you divide that by 1. Or you can use the gross profit divided by the cost of sales, and then you multiply that by 100 divided by 1. Okay, and that would bring us to the end of our theoretical part. Okay, the gross profit calculation, it would just, the example would go as follows. Let's say your sales is 200. The selling price, you see my writing there? Is, I just want to get a figure that will give me the weight percentage. Let's say it's 400. So this is what you're going to do. You just say 200, you divide this by 400, and then you multiply this by 100, you divide it by 1. Now it is. Let me just see. Let me just see on my. This thing would give me. All right, it should give you like something like 50%. So you just say 200 divided by 400. This one is just not a big deal. It's just the basic foundations. Right? So you just say sales minus my selling price, and then you multiply by 100. So, all right, let's say gross profit is 2,000. And then the sales, actually it should be sales. Usually the sales is bigger than this. Okay, let's go to 4,000. So what you do, say 4,000, divide that by 2,000, then you multiply this by 100, you divide it by 1. You see quickly as to what percentage is it giving me. 4,000 divide 2,000 multiplied by 100 divided by 1. 4,000 divided by 2,000. This is when you're using the round figures. Divide. All right, yeah, it is 20%, sorry. But I would, this is in the guide. I'm not sure about the textbooks, because you guys, you know that we are not allowed to use the textbooks here. So it might be in the textbook as well, but I'll get a comprehensive example where it affects maybe the transactions in the textbook. But anyway, on the next one there, it's either you are given the gross profit and the cost of sales, or you have to determine how much the gross profit is and the cost of sales, and then you adjust it by saying gross profit divided by the cost of sales, and then you multiply that by 100 divided by 1. So this is all your income statement components, basically. Okay, let's say number one, we had a packaging material. This is inventory of R400. Okay, I'm just gonna line them down. You've got insolvent data. Oh, Yumugaba. The amount is 200 rand. Then we have the transaction says that. Why can't I find this question for me? Hold on, let me. Hold on, let's say the 31st December 2022, 3 employees paid salary of of 4,500 each for January, April 2023. Okay, that will be our transaction number 4. And we had depreciation for vehicle fittings with an amount of of 6,000 rand. And 7,000 rands. 5, let's say 1,000 the commission, and the 31st December 2022, the amount outstanding. And we have insurance. Premium. $300. That has been paid. Until February 2023. We've covered the rental income has been received until the 31st March 2023. Let me see. Okay, required investment journal. Danny, I did this thing with you. Adjustment and closing transfers journal. You'd have an idea. Basically, this is what I was looking for. It's one of the questions that I have developed, but unfortunately, I couldn't. I'm not sure where is it placed in my laptop. Adjustment journal. Correct. The rent value. Anzani. 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 All right, Jimmy, do you want to take a shot on this for me? How are you going to do your adjustment journals on this?
To be honest, I'm not sure about it yet.
Okay. Anzani, please help me. Anzani, this is one of the part that you said you were experiencing some difficulties on it. Do you want to help me? Okay, the first question goes as follows. Packaging material of 400 rand. So basically what you're going to do, it's you are going to say it's an adjustment journal. You're going to say you debit inventory, which is packaging. The amount will be 400 rand. Then your contract will be inventory itself, right? Packaging material. That's your inventory. Okay, because the main aim here is to show you the adjustment journal, credit loss, or you can just go bad debts. And your contract allocation account will be trade receivables or trade debtors. The amount is 200 rand on the credit and 200 rand on the debit. Okay, remember the credit loss is an expense, and then it reduces the debtors on the credit side. That's why you see 200. on the credit side. Right. Moving on, we can have, let's see what the question says. Number 3 says, on the 31st of December 2022, 3 employees were paid a salary of 4,500 from each for January to February. So there was an advance payment in regards to staff members that were paid from January up until April, which is 4 months in a row. So basically what you're going to do, you would say, your recording will be like this, payments, and then your credit will be salaries. Okay. But this is what you are going to make in terms of the adjustments. I would say 3 employees. Remember, you're calculating now. Multiply by 4,500. And then you're going to multiply them by January, February, March, April, 4 months. Makes sense. Can somebody give me the calculations there? How much is 3,000? How much is the 4,500 multiplied by 3 employees multiplied by 4 months?
Oh God. I don't know.
You don't know, nobody. Sorry, Anzani. What did you say?
It's 54,000.
54,000 rands. Okay. Okay. Basically, what you do is prepayment on the debit is an asset, 54,000, and with it for as a contra allocation account is the salaries. 54,000 rand. So this is how you're going to. I just did this intentionally so that when you read the question, I want you to be careful and to understand exactly what are they talking about. So do not forget, it's 3 employees, each worth 4,500 rand, and it was paid for 4 months. That's why we've got 3 multiplied by 4,500 multiplied by 4 months. Make sense?
Yeah, it does.
Okay. We move on, and sorry, let me just go and look at transaction number 4. It says depreciation for the vehicle is 6,000 rand, and for the fittings is 7,000 rand. So we're still going to add those two. I think it's about 13,000 rands. So it's easy as well. Just say depreciation. Okay, and you will say accumulated. Remember that's the contra allocation account. Accumulated depreciation. But and then you'd say 6,000, add them together, plus 7,000. Totals 18,000 rands. And then your debit, it's an expense. You debit your depreciation, which is 13,000. Sorry about that. Oh, come on. 1, 2, 3. But in your contra, which is the accumulated depreciation, it will be 13,000. Make sense?
Yes.
Okay. Let's move on to 5. 1,000 rand of the commission was earned on the 31st of December. Sorry, that's that 312 here. It's a mistake. 31st December 2022, and the amount is still outstanding. What does this transaction tells you?
It's an accrued income.
It's an accrued income, right? Okay. Then how are you going to record that? Thank you so much, Jimmy. Recording.
It's an asset, isn't it?
It is an asset. That's correct.
It's a debit balance.
Debit balance.
And then the contra account would be accrued interest received.
Okay, let's see. No, the accrued income will be commission earned.
Oh, yes, commission.
That's a great try. That's a very great try. Commission earned. How much is the amount due?
It's 1,000.
1 grand. Okay, and then are you following, my dear?
Yeah.
Yes, I'm following.
Are you following, Anzani?
It's 1,000.
Yes,
1,000. Okay, distributes. There we go. Let's have a look at transaction. I think it's 6. Insurance premium of 300 Rand has been paid up until February 2023. Zani, what's your take on this? Zani? Payments? You agree?
It's prepayments.
Prepayment, that's correct. The amount? 300. Prepayment is actually the debited account. The contra allocation account will be insurance. Do we agree?
Yeah, okay.
So you will debit your 300. It's not bad. If you look at your study guide, you would understand. I always advise or encourage the students to go through the theoretical part first. And things will be easy. Once you understand the theory, because you apply it into the practical questions, it's going to be it's going to be way much easier. Okay. Anzani, are you still following? Anzani, are you following? All right, rental income has been, I think I made a mistake here. So up until February, it's for 2 months. So you must just say 300 multiplied by 2 to give you 600. My apologies. Okay, so showing your figure here, it will be 300. And then you multiply this by 2. And it'll give you Jan to Feb 2023. Yeah. Okay, let's have a look at the last one. Rental income has been received until the 31st of March. Okay. Zani, you want to come? What am I debiting here? Or which accounts are affected?
Sir, put our year end. It's on which month?
31st December 2022.
So that means we have received prepayment on income for rental.
For rental, yes.
Yes.
All right. Okay, let me go up to the question so that I can be on the same page with you. Rental income has been received up until the 31st of March 2023. All right, let me just say, I think there's something that I missed out here. For, let's say, 1.2 a month. Does this question make sense now?
Yes.
Right. Jimmy, how do we record that?
Because we have received an income for rental that has been paid in advance.
Yes.
It's a liability because
it's a liability.
Yeah.
That's correct. So it's like I have interrupted you. You were coming all right.
Okay. So we are going to multiply that 1,200 by 3 months.
Yes.
And then we are going to debit no, I can't go on. Sorry.
Okay, let me just give you a hint on a bit of a lead. All right, we are going to debit. We have received the money. What are we debiting? We're going to debit the rental income simply because
Okay.
bank goes up. Remember, we have received the money.
Yes.
Then we're going to credit the income received in advance.
Okay.
That's the liability.
Yeah.
Right. But I like the fact that you've seen the amounts there. You realize that we have to multiply this by 3, right?
Yes.
It's supposed to be how much? Is it 3.6?
1,000 times 3.6, yes.
3.6, I think I was right. Okay, that brings us to the end of our adjustment journals. Who need clarity? Who need further explanation on this before I move on to the closing transfers? Okay, you can go ahead, Jimmy.
I don't know, how should I approach, because sometimes I get a bit confused about which account to debit, which to credit.
Okay.
So there is this thing that I've tried to, we debit the receiver and credit the giver. So, but somewhere along the way, I can't use it as accurately as I wish to.
Okay, that's a very important question. That's a good one. The approach to that one, I think I was just telling Azani when we started about this class. The approach to that one is you need to unfortunately or fortunately comply with what's called accounting equation. Okay?
Yes.
Right. Why am I saying the accounting equation? Because it helps you to build up on an understanding of what goes to the credit and what goes to the debit. And it's 2 things and 3 things that are actually differentiating there. Remember, in terms of the components, we've got assets, we've got equity, we've got liabilities.
Yes.
Right? And then we then have again income and expenses. It's 5 things that you must always bear in mind. Right.
Yes.
And going further to understand that, you would say your assets and your expenses, they increase on the debit side and they decrease on the credit side.
On the credit side.
And then your incomes, your equity, and your liabilities, they all increase on the credit side and they decrease on the debit side.
Sorry, Puti, I think that I'm clear about it, and I've tried to know it as much as I. But when coming to write like differentiating the accounts involved, I think that's where I get confused. So to
do you maybe have a specific example? Give me an example and then I'll give you a hint as to how you have to approach it.
Okay. A debtor paid 1,000 rand into the banking account
of the company.
Yes.
Okay, Puti is a debtor. Puti paid 1,000 rand to the bank account of Jimmy.
Yes.
Okay. First thing that you must establish, which financial statements are you dealing with? Is it Puti or is it Jimmy?
It is Jimmy's financial statement.
Sure, that's you, right?
Yes.
And I pay you.
Yes.
Okay. The first thing that you must do, Jimmy, is to what's called identification of the accounts.
All right.
Identification of the accounts, it means which accounts are affected or which accounts are involved in this transaction.
The accounts that are identified, it's a bank and a debtor.
It's the bank and the debtor, right?
Yes.
Sure. We have identified the accounts being the bank and the debtor, right? All right. As soon as you have identified the account being the bank and the debtor, what is a bank and what is a debtor? They're both an assets, right?
Yes, yes. And they both increase on the debit side.
That's where you go into limit, because when you deal with the issue of the increasing on the debit side, I think it will have more effect when we are at an initiation stage.
Okay.
Okay. But now, Put is paying Jimmy, right?
Uh-huh.
We identify the bank and the debtors, right? They're all assets. Assets increase on the debit side and they decrease on the credit side. Okay.
Okay.
And then I paid you 1,000 rand. So meaning that Jimmy's bank account is actually increasing. Are we making sense? Am I making sense?
Yes.
It's increasing because Put is paying the debt of 1,000 rand towards Jimmy's bank account.
Uh-huh.
So what are you going to say? I'm debiting my bank because it's an asset. It increased on the debit side, and I'm going to debit that with an amount of 1,000.
And then credit.
And then you credit the trade debtors.
Okay.
Okay, Jimmy, now I've got a question for you, right? We pause it there. Why do you debit the trade debtors?
I think because they are paying.
That doesn't satisfy the, sorry about that, the 100% reasons.
Mm-hmm.
All right. It is because you're right by saying that, but I think you're partially right. It is because the debtors are paying, right?
Yeah.
Meaning that our debtors are decreasing.
Uh-huh.
Does that mean when a debtor is paying, it means that they are coming down. If your debtor's account was actually 2,000 rand, and then one of the debtors is paying 1,000 rand, it goes down with an amount. Let me just not equal the amount because it's going to confuse you. If your total debtor amount is 2,000, right?
Yes.
One of the debtor which is Put is paying 400 rand, meaning that the debtor's balance is coming down to 1,600 rand.
That's right.
That's a decrease. Do we agree?
Yes.
Good. Now we have identified the movement of the figures. What we're going to do is, on which side does the debtor decrease and why? Ciao. In terms of the accounting standard, the debtor is an asset and assets are decreased. The credit side. Am I making sense?
The assets are increasing.
Decreasing on the debits on the credit side.
Are decreasing on the
credit side.
Yes.
But you understand the analogy behind this whole thing?
Okay.
All right, let me just explain it again. The total amount of the total debtors is 2,000 rands, right?
Mm-hmm.
And then one of the debtor, which is me, Puti,
Yes.
I'm paying 400 rand.
Okay.
You're going to minus it from the 2,000 rand, right?
Uh-huh.
That will bring it to 1,600 rand. They are decreasing because it's no longer 2,000, it's 1.6.
That's right.
We go back to the principle and say, but our debtors is an asset and they are decreasing.
Okay.
The bigger question will be on which side does your asset decrease?
On the credit side.
Yes, that's why you are actually putting that on the credit side.
Okay.
Makes sense?
Yeah.
Okay.
All right. Thanks.
So basically you're going to have my bank is actually increasing with an amount of how much? 600 rand. But that reduces the debtor to how much? 1.6. So let's now go back to the principles. The bank is increasing. It is an asset. On which side does the asset increase? Debit side. Then you put 300 rand on the debtor side.
Okay.
Makes sense?
Yes.
Then you're now going to look at, okay, what is now going to be the leg that has to be affected? You remember, you still need to feed what's called the double entry system. If you're only going to record that under the bank, in terms of accounting, we call that an incomplete record. Because the double entry system says that the effect must be two or more legs.
All right.
Makes sense?
Yes.
And then when you go back and say, okay, the what do you call it? The trade and other receivables is a debtor, which is an asset decrease on the credit side. Then we bring it back to 1,600 rand.
Okay.
Okay, so but the 1,600 rand is going to be from the 2,000 rand. Remember, you're going to have an opening 2,000 on the debit side, but you're going to say credit side, you're going to say 400 rand on the credit side. Then that means that the debtors that are outstanding now, they worth 1,600.
600.
Yes.
Okay.
Does that make sense?
Yeah, it does.
Okay.
Thank you.
Okay, my good people, it seems like we are running out of time, but I've got a big assignment for you, and then we'll see you there on Tuesday. I'm just left in 6 minutes, so I might as well just give you a break because I think, especially Anzani, she must be tired. Listen, this is what I want you to do for me. Before we meet on Tuesday, we'll meet there. When we meet on Tuesday or Wednesday, it might be. I want you guys to, this question, it's in my study guides, it's in page 149. I'm using the old guide. It's not going to be the same. Okay. So I want you to write the following down so that you'll be able to see which one am I talking about. The comprehensive question that I'm talking about, the name of the company, it's Hot Rod Dealers. Are you all there?
Yes.
It's Hot Rod Dealer. It doesn't have that much of an information. It just has the pre-adjustment trial balance and the additional information. But what I want you to do for me, you're going to do me the closing entries. It's number 3 as part of the required.
Okay.
You can do it whichever way you want it. You can just look at the solutions. You can do it without looking at the solutions, I know, but I'm not encouraging that because I know it's not going to make you learn. You can do it without looking at the solution, it's going to make you learn more. However, I don't have a problem with the figures. I don't care about the amounts that are actually here, but I care about the principles. The principles mean that when we meet, please tell me why did you debit that and why did you credit that?
Oh, okay.
Okay.
All right.
Yeah, so whether you get 1,000 instead of 4,000 or something, that's not a big deal for me. The big deal is why do you credit or debit depreciation? I need the reason behind that. That's the key principle in accounting.
Why debit
and credit? For example, now why on the example that you just gave me now, the reason behind is we debited the bank and then we create the trade and other receivables. There's a reason behind why we did that.
Okay.
And the reason why is because of the bank is increasing and the debtors are decreasing. I want that kind of a reasoning.
Oh, okay.
Right.
All right.
Thank you guys for coming in.